So moving on to international finance, balance of payments accounts, and so on and so forth. What we're talking about here is this. Before in international trade, we were talking about the goods and services that were being exchanged, being traded back and forth. And the international finance component has to do with the financing of those exchanges and how the financial process works in making those exchanges occur. So we'll just jump right into it. So when we talk about, for example, the place where most of this information is housed, it's the Bureau of Economic Analysis, and we're looking at the international transactions accounts, or the balance of payments accounts is more correct, the BOPA. And again, what we're looking at, just to get the ball rolling here, we're looking at the export of goods and services and income receipts, and that would be how much we're exporting. This is for the year 2021, as opposed to what we're importing, and that's the line item number 9. So the exports were $3.8 trillion. So this is a huge portion of the economy. Remember, we're talking about a $20 trillion economy, and we're looking at roughly $4 trillion exports, and well over $4.5 trillion on the import side. So just that in and of itself, we're talking about a huge portion of the economy. So this is the foreign sector, the international trade, the back and forth, if you will. So the export side, we're at 3.8 trillion, and the import side, we're looking at 4.6 trillion. The difference between the two is on line item number 9, that's the balance on the current account. The current account, it's not just the goods and services, it's not just the trade account, if you will, but it also includes some other investment income and income receipts and so on and so forth. The takeaway is that $846 billion of a deficit, if you will, is a deficit on the current account balance, which again, for all intents and purposes, we're talking about the trade balance, which would be a number that would be, I think it's item number 29. But at any rate, that's kind of a quick overview. We're looking at, again, the financial part of the transactions associated with those goods and services that are being exported and imported. We're looking at that relationship. So looking at it a little bit differently, or just looking at it over a time, over a timeline. If we go back when we're looking at this deficit in the current account balance, the trade balance again, for all intents and purposes, in 2021 it was 821, almost $822 billion deficit, and the last time that we actually ran a surplus, or we did not have a deficit, would be looking back, 1991. So a long time ago, right? So we're talking over 30 years ago. And actually prior to that, it was 1991. And the reality is that was a bit of an aberration. If you go back even further, it would be back to 1981. So really, we're talking about 30 years since we've been running trade deficits, where we've been running current account deficits. So this is, first off, it's nothing new, and it's been ongoing, and there are consequences to this, and we'll be talking about that as we go forward. So again, one more time, this is a little bit of a smaller view going back to about 2003. We've been running consistent deficits, current account balance deficits, current account deficits going back again for the last 20, 30 years. And there are again some consequences to that, which we'll be talking about shortly. So breaking this down into a little finer details, we're looking at a very, very large trade partner, right, with Canada, looking at exports to the tune of $442 billion. Remember, we were talking about an overall export being about 3.8, and anyway, just below $4 trillion, and the imports similarly over $4 trillion, obviously. But this is a very large segment, almost probably on the order of 10% of our trade is in effect with Canada. And what you'll notice is that, yes, we have a trade deficit in 2021 with Canada, but we've kind of gone back and forth on that over the years. We've actually had a pretty balanced trade so far as our imports and our exports are concerned with Canada. And then along comes China. To begin with, we didn't have much in the way of imports and exports with China going back to, again, 2003. It was not that it was insignificant, but it was not as large as it's become today. And in fact, what we see is a huge disparity. So to put it in perspective, and we'll be getting this in finer detail as we go forward, China has increasingly become, we've been running current account deficits with China, meaning that we've been importing more from China, significantly more than we've been exporting. And what you'll notice is that those imports from China have been quite large over the years, and they signify they're the largest trading partner, if you will, on the import side, and at least that side of the equation, they are the largest, and they constitute a good portion, probably close to half of the current account deficit is with China. Now, in this chart, I should say, in this table, however you want to look at it, put together something where we're looking at the relationship U.S. and China so far as we're adding up, totaling up these balances, these export imports, and the current account balance with China from 2003 through 2021. And what we see here, if we look at these current account balances, it's huge. We're looking at $5.8 trillion insofar as that imbalance of trade is concerned on that current account balance. It's just absolutely enormous, and there's a huge disparity. We're not, we're exporting $2.6 trillion worth of goods and services, and we're importing $8.4 trillion worth of goods and services from China, and that is something that there are grave consequences associated with that, reasons behind that, and so on and so forth, which we will be getting into. So this is, again, the U.S. with the world, so far as totaling up our exports and our imports and the balance on that current account. What you'll notice is that much higher numbers, $55 trillion versus $65 trillion in imports. 55 in exports, 65 in imports, so to the tune of the current account balance of about $10 trillion. And what's interesting about that is that a huge portion of that is actually associated with China. And again, U.S. and China relative, again, to that portion of the world, we've exported 4.8% of our total for the world to China, and we've imported 13%, nearly 13% of our entire imports are coming from China, a huge portion for this current account balance of 57.3%, meaning that that current account balance of $10 trillion, approaching 60% of that is owed to China, so far as that current account balance is concerned. Just absolutely enormous. This is just to put it into context. So again, Canada has been pretty even so far as exports and imports are concerned. Large, very large, $7 trillion from 2003 through 2021, and about $7 trillion in imports. So it's pretty darn close with a $43 billion. I know these are huge numbers, but relatively speaking, it's pretty darn small. So far as that current account balance, that current account deficit is concerned. So the trade is pretty even so far as Canada is concerned. Something else to keep in mind. So continuing on again, looking at what this is really all about so far as this current account deficit with China, how it's developed over the years. It was not quite so high, obviously, going back early on, but it progressively gotten worse, and to the point of in 2018, that China, the trade with China accounted for 82% of the total U.S. current account deficit. 2013, 93%. In total, again, from 2003 through 2018, that total trade deficit we're talking about, the current account deficit rather, was at 57%. So China is a major player, obviously the primary player so far as our imports are concerned, our current account deficit, importing more than we're exporting. So this is another representation of the same, that with the entire bar going down, with the orange and the blue combined, that's the entire world. And the blue portion on the top is the portion of that trade deficit, that current account deficit, that is associated with China. And what's interesting about it, of course, is that it's become increasingly, the numbers have risen, over the years so far as that trade deficit with China is concerned. So a little background. So this is just, reading this off the chart here, we'll talk more about it. But China launched reforms in the late 1970s, resulted in migration from the countryside to the cities. The rationale behind that, of course, had to do with the over concentration of people in the agricultural, agrarian China, if you will. So the aim was to take people off farms, making the farms more efficient, mechanizing farms with equipment, machinery, etc., and pushing those folks into the cities. So in an effort to employ those people moving into the urban areas, the Chinese moved forward with plans to grow its economy by devaluing its currency. We'll talk about this in a second. What happened was that these people were moved, basically they were not all that schooled, okay? So we're talking, they're not necessarily illiterate, but they did not have much in the way of education. Moved into the cities, in these concentrated cities, and education became much more prevalent. And so you had a lot of people that were receiving a lot of education, and what to do with them. So the idea was to start an export economy, or push an export economy. Anyway, the Chinese again moved forward with the plans to grow its economy by devaluing its currency. We'll talk about this in a second. This resulted in cheaper Chinese goods to grow its exports. Unrest resulting from the Tiananmen Square protest in 1989 increased government's efforts to expand the export industry much more quickly by further devaluing its currency. So here's the story. 1981, we're looking at the Chinese yuan being at 1.7 yuan per dollar, per US dollar. And as we move to the right, we start to see Tiananmen Square in 1989, we're looking at 3.77 yuan per dollar. So as this is going up, keep in mind that that currency is being devalued. That Chinese currency is being devalued. They purposely have done that. The central Chinese bank have made it by supplying more yuan and we'll get into this, but by making it relatively cheaper, that much cheaper compared to the dollar. So they purposely did this. They devalued their currency. In 1993, we're looking at 5.78. Remember, the higher the number, the lower the value of the yuan is compared to the dollar. 1994, it was up to 8.64 yuan per dollar. In 2018, 6.61. And I think we're still at about 6%. I may have the number, or excuse me, 6 yuan per dollar today, or thereabouts. And we'll get back to that in a minute. But this is the rationale, that they wanted to devalue their currency to make what? Their products overseas less expensive. So they're trying to make them more attractive for foreign buyers. So the Chinese exports became more attractive for the other country, the U.S., for example, importing those goods and services. And we'll look into this in greater detail as we go forward. But just keep that in mind. The objective in devaluing currency is to make your currency worth less so that the goods and services that you are selling abroad are less expensive. Straightforward. So that promotes what? Exports. So again, how did we end up with so much of a trade deficit with China? There's going to be more discussion. It wouldn't just be with China. This has happened over and over again with other countries, including Japan, Germany, and anyway. So exchange rate, keep in mind the exchange rate is the price of one currency relative to another, or perhaps even a basket of other currencies, whatever those might be. So we're looking in December 6, 2021. I should have more current data, but anyway, this will do. December 6, 2021, 1 euro was equivalent to 1.13 US dollars. And the flip side of that, flip it upside down, $1 was worth 0.89 euros. I think they may call them cents, but anyways, 0.89 euros, right? So in July of 2022, for example, the Chinese yuan was worth 15 cents US, $0.15 US. And $1 was equal to 6.75 Chinese yuan. So it's actually was a little bit lower, meaning it was the exchange rate was a little bit lower than I thought. So the Chinese yuan was actually worth a bit less than I thought before. So what we're talking about is that one currency in relation to another. So when we have depreciation, appreciation, devaluation, revaluation, what happens is that when you have a freely floating exchange system, for example, you have depreciation and appreciation. So if the dollar increases in value versus the British pound or the euro, that means that the value of the British pound or the euro goes down. If the dollar appreciates relative to the euro, then the US dollar price goes up and the British pound, again, for example, would go down. And the flip side of that is that the British pound, if it's appreciating, rising in value, then the dollar would be depreciating or losing value. And so that's the freely floating exchange rate. Let the markets kind of control themselves. And the way it works, quite simply, is that, say, for example, you buy goods and services coming from the UK. So what do? You pay for those with dollars. And where do the dollars go? They go back to the UK. So that increases the supply of dollars that are out there on the market in toto. So that would, by the nature of it, the opposite would be occurring, meaning the supply of dollars increases, so that's going to depreciate the dollar eventually. This is that balance that kind of happens out there so far as this depreciation and appreciation is concerned. Devaluation versus revaluation, this is when central banks step in and reinforce a depreciated dollar or an appreciated dollar or a depreciated yuan or an appreciated yuan. So this is that if you want to depreciate, that would be a devaluation. But it's a central bank stepping in to make this happen. So they're actually doing this. The revaluation would be to make it worth more relative to this other currency or basket of currencies, however you want to put it. So the Chinese, of course, are, they state that they don't, but they are very keen on keeping the Chinese yuan at a lower level, meaning they want that exchange rate, again, 1 yuan to a dollar to be 15 cents or some number lower even perhaps. So the floating exchange rates occur when we're talking about depreciation versus appreciation, where it goes up and down as according to whatever the market forces, the pressures that are out there, all the variety of market pressures that are occurring at all times, right? Fixed exchange rate is that central bank stepping in to making sure that the currency is where they want it to be. Example of this would be, again, if the Chinese, you bought something, some Chinese product in the U.S., the dollars go back to China, and so China would, if in an appreciation, depreciation sense, the dollars would, they would increase the supply of dollars, which would drive down the price of the dollar. But the Chinese central bank does not want to happen, so they do some other things. And we'll get into these other things to insulate that so that the dollar does not drop in value relative to the Chinese yuan. Finally, the managed float, that's a pegged rate. That's where it's allowed to fluctuate, appreciate, depreciate within a certain band. And if it goes too high, then the central bank intervenes. If it goes too low, the central bank intervenes. So here's our example, and it may or may not be an appropriate example, but it's something we can all probably get our heads wrapped around. So it's US versus China comparison. So here we are in 1984. We've got televisions that are priced at $125. So the price of the yuan at that time was 2 yuan per dollar. So in the US, the television was priced at $125, and for the Chinese, they would also price it at 250 Chinese yuan, or yuan, okay, so 250 yuan. 125 US dollars, same price, everything is on par with one another. US producer sells for $125 per TV, and the Chinese counterpart also sells for the same price, 250 yuan or $125. Fast forward to 1992. The US dollar is at the price, if you will, for the television is the cost, we'll just say the cost of the TV is $125 US, and what's happened is that the yuan is actually depreciated. So we've gone from 2 yuan per dollar to 8 yuan per dollar. So that $125 US is suddenly 1,000 yuan. So the US producer sells that same television set for $125 per TV, and the Chinese counterpart, based on the devalued currency, can sell it for $125 divided by 4 because of the currency, the exchange rate, which equates to $31.25. So all else equal, the Chinese seller or producer could sell at $31.25, which would equate to the $125 for the U.S. So the takeaway is, again, ceteris paribus, they can sell well below the $125 U.S. manufacturer's price. So, for example, the Chinese manufacturer might sell it for $75, and the American producer's all-in cost, the opportunity cost, etc., the selling price is at $125. Again, that includes that opportunity cost. Plain and simple, the American firm cannot compete. There's no way. There's no way they could take out $50 out of the price of their TV and stay in business. The same thing is also with Japanese and Germans. This is the so-called German miracle, the Japanese miracle, and now we have the Chinese miracle. And we'll get to what we mean precisely as we go through. But one thing to take away at this point is that in order for the Chinese to be able to do this, to make this happen, so far as devaluing its currency, the U.S. has to accommodate that. We have to allow that to happen. So keep that in mind, and we'll talk more about it. So once again, the backstory, if you will, in the early 1980s, actually again it was in the 70s, as I mentioned before, and before that perhaps even, they began moving people from farms to cities. Remember that whole concept of diminishing returns. If you have too much labor, then you reach the point of less than zero total returns, and it's so they had no choice, or at least they saw this as a losing proposition. So move the people off the farm. How could the Chinese government get all those farmers working in the cities? Meaning they moved millions of people from the urban markets, or the rural markets, into the city. And you can see on the chart here, it was a massive change going back to, we'll just say 1949, all the way forward to the year 2020. There's been an increasing movement away from the farms to the city. Same things happened in other countries, developed countries as well, but in China this was done on a massive scale, and it was all government run. They made this work. So the point is again, how do you get all these farmers working in the cities? You start with, you educate them. How do you provide them jobs? The way that we've already talked about was to create an export economy. And the way that you create an export economy is make it conducive for other countries to buy your products. And the way other countries buy your products is if they're low priced. And the only way you can make that happen is by having your currency either depreciate or devalued. So they devalued their currency. And so what was the impact? Tiananmen Square in 1989 was kind of it really wasn't, people think it was about freedom. Yes, but it was more so about jobs. All these people that had moved to the cities, they had education, and they didn't have a job. So they just pushed the government. This was the Tiananmen Square movement in 1989, and it actually accelerated this continued devaluation to the point where it was in 1994, where the yuan was at 8.6 yuan per dollar. It had been devalued a great deal, a significant amount. So again, we've got the iconic symbol of Tiananmen Square, and this was in 1989, and this was also, again, showing that major transition from rural to urban settings. So you now have cities, you probably have 100 plus cities in China with more than 1 million people. I'm sure there's 200 plus with 1 million or more, but at any rate, they're just enormous cities, some tens and 20 millions of people. And again, this was this iconic image. By the way, we've never been able to locate this person who stood in front of the tank to stop the tank. I don't think he's ever been seen again. So that was he was disappeared. All right, and at least that's what I've heard. I'm assuming that's still the case. So onward. So if we're looking at this, is another image on the right of that transition moving from rural populations to the urban population, moving more and more to urban, to the point where you've completely overtaken the rural population by the year 2020. Just a massive change, and relatively speaking, very quickly, very quick. So a quick lesson, quick walkthrough on international finance, or going through the 20th century to pretty much the current day. We had the Great Depression, which went from 1929 roughly to 1940, and some people say it really wasn't over until the end of World War II, because in essence, through World War II, we had no consumer goods at all. This was all wartime production, so it really didn't count as economic prosperity, if you will. Black Tuesday occurred October 27, 1929. That was the kickoff date, if you will, for the Great Depression. Smoot-Hawley, the tariff was implemented, passed in 1930. So you had these were competitive rounds of competitive depreciation of the currency and tariffs, and it was just an absolute mess. So you had the economic collapse followed by this nightmare of rounds of tariffs that were the Smoot-Hawley tariff in 1930. So it could not have happened at a worse time, when we're going into depression and you pretty much cut off all of trade with the outside world. By the way, Germany had what was called the autarky, which was no trade. If you couldn't produce it in Germany, then we don't want it type of a scenario. This happened again through the 1930s, leading up to World War II. So following World War II, after that mess, with the only economy pretty much intact was the U.S., we being the U.S., put together plans to do two things. One, to get the international trade sector back up and running, and also to work on the international finance end. And in 1947, the IMF Bretton Woods agreement that was in Bretton Woods, New Hampshire. The IMF is the International Monetary Fund, so that was the financial end of things, and trying to get the world back on target. And basically the way that it was done was that the U.S. price for gold was set at $35. The price of gold was set at $35 per ounce, which was very high, meaning the dollar was valued extremely high And the reason was that we wanted to encourage trade. So if you've got a very strong currency, what happens is that when you import goods and services, those imported goods and services are not as expensive. And that's what the aim was, to get the world going. So the U.S., this is the locomotive effect, right? The U.S. buying goods and services from abroad. So again, the U.S. is pretty much the only intact economy after World War II. So in essence, then, to protect trade, the U.S. was compelled to export dollars. That was the result of buying foreign goods and services, because remember, you're exchanging dollars for those goods and services that you're purchasing. So what happened was, the downside for other countries was that they had to hang on to those dollars and to keep them in their own possession. And unfortunately, what happens is that when a central bank has anything in its possession, it has a tendency to promote inflation. And on top of that, too, when you're exporting more than you're importing, that surplus, that tends to also be inflationary, because you don't have the goods and services for your populace to use that extra income to purchase, is really what it comes down to. Anyway, so in 1960s, the French president, Charles de Gaulle, was tired of holding excess U.S. currency, so he demanded gold in exchange. And it was set at $35 per ounce, and he wanted to exchange his dollars for gold, and that would have pretty much wiped out Fort Knox at $35 an ounce. So rather than doing that, what happened was, and this came a bit later, the dollar was raised a bit higher, if you will, and it continued to do so in what was called the Smithsonian Agreement. But again, this was all initiated by the French, who finally said, no, we can't do this. This is too inflationary for our own economy. It's detrimental to our own economy. So the Smithsonian Conference was the beginning of the end for the dollar's attachment to the gold. We didn't have a gold standard, but there was an attachment to gold prior to this, and it went first from $35 an ounce, where it was, to $37, and finally the dollar was allowed to float relative to gold and anything else. So what that in effect did was it unshackled the dollar from the price of gold, and the price of gold went up, and now we've got gold at $1,000 plus an ounce. I have no idea what it's at, but it's well over $1,000 an ounce, and it will probably continue to be so, to be at that rate or more. So anyway, and it wasn't just France; it was also increasing pressures from Japan and China, because they were holding on to all those U.S. dollar balances as well. And then what happened was we had the oil shocks. 1973 and 1978, 1979 caused significant disruptions so far as international financial markets were concerned. And the thing is that, here's a question. People say, why don't we have the gold standard? The problem with the gold standard is that it ties your income to gold. It ties your currency to gold. And that restricts your ability to borrow. You're restricted by what? By the amount of gold that you have in your possession. So what happens is that we say that a gold standard, it limits domestic and international policy. And we say it's also the first casualty of war, because what happens is that countries go out and buy whatever they want to, and with the gold standard, you're losing your gold reserves as a result, and until you reach the point where the gold reserves are gone. And without the gold, you're unable to what? To prosecute your wars. So this is why we say that the first casualty of war is a gold standard. And a gold standard prevents politicians from doing what they like to do best: overspend, spend beyond their ability to spend, if you will. And so you would, in order to do that, of course, you have to borrow. So it limits. Gold standards just don't work because of that. Anyway, onward. So just to kind of wrap things up, We had, again, on the international trade side, what's called the GATT, General Agreement on Trade and Tariffs, or Tariffs and Trade. And that was 1947. That was a counterpart to that IMF Bretton Woods in 1946, where we were talking about trying to get the tariffs in line, to be able to have something to some international body to kind of keep tariffs at bay, try to limit the amount of tariffs. The WTO took over in 1994. That's the World Trade Organization for GATT. I'm not sure if GATT is still anyhow, WTO basically took over in 1994. And so they're the international trade folks, and they're the ones that also in the late 1990s gave the most favored nation status, trade status to China. And has it worked out for us? No, it has not. We can go into that in great detail, but the takeaway is that our international trade has been an absolute mess since the early 2000s. IMF, again, is that foreign exchange, which is this is the financial side, the continued changes with IMF, Bretton Woods. We've gone further than that. The U.S. dollar is still the key currency in the world, and I don't see it changing. It could, but I don't see it changing. Exchange rate blocks, those are like the European Union is an exchange rate block. The USA, for that matter, is as well. Think about it. Prior to the form of the United States of America, we had 13 colonies, and they all had their own currency. So when you come together, that's what we call an exchange rate block. So the formation of the USA and the EU, we're bringing together this exchange rate block, right? Exchange rate block. So national sovereignty is your ability to conduct domestic policy. And once again, why allow China to run trade surpluses, our deficits? This is the last thing that we'll talk about here. And if you think about it, this has been going on since the 1990s. And the primary reason, to be totally honest with you, it goes well beyond economics. It has more to do with politics. It's like a geopolitical thing. If you think about China, everyone thought that China was going to become more democratic, move more toward free markets, and so on and so forth. That has not happened. The Chinese Communist Party is as much control today as it ever has been, if not more. So you're talking about 90 million people that are in charge, if you will, over a country of 1.4 billion. Just huge numbers. Anyway, the rationale was that we in the West, including the U.S., etc., wanted China to be would prefer China to be a pretty calm place, right? Not with a lot of political upheaval, etc., and especially considering where they're located. So you've got China surrounded by whom? You've got China surrounded by then the Soviet Union, Russia, of course, North Korea, India, and Pakistan, who are constantly at war with each other. So you had these nuclear nations that were surrounding China, and so we were hoping that we would have a China that would be much more in agreement with us and move closer to us as the years progressed, and not being so much a competitor as an ally. And that has certainly not been the case. Anyway, I'm not going to get into the politics of it. I already waded in probably further than I should have, but you get the idea. So that kind of wraps it for international finance at this point.